Yeah, guys. So let us continue with our option trading strategies. So just a quick recap what we have covered till now. We have covered what are the different Greeks in the options, and particularly we discussed that the most important for us to consider is the theta and the vega. So in today's video, I'm going to cover how to interpret vega, what is the wicks of the index and how to interpret and trade the wicks, and eventually when to buy or sell your options. So we'll quickly start with what is the definition of Vega. So Vega is the price change for each percentage point change in implied volatility. What it means is basically the change in the call option price because of change in the implied volatility will be termed as Vega. So we have used Vega and implied volatility interchangeably, but that was for simplicity perspective. But to actually observe the volatility, there are two ways to compute a volatility. The first and the very simple way is the normal stats method, is wherein you take your historical prices for each period and then compute the standard deviation and the variance, which is your volatility. This is the historical method. But a lot of times this historical method might not hold true, right? Because there is no guarantee that whatever has happened in history will happen in the future also. So what we need to do is basically we have to use option models to compute the call option price. So what are the two major option models? One is the Bsm model and one is the binomial option model. Bsm is the very popular one that everyone knows, is basically the Black-Scholes model, and binomial option is again a probability based model. So today we are going to consider the Bsm model. So by definition, this is the complicated formula for Bsm call option. What it actually means is basically the value of a call option is current strike price minus x is used for E is basically strike price, x discounted at the risk free rate for the remaining period of time. Current stock price minus the strike price discounted for the remaining period of time at the risk free rate. And there is two different variables over here, nd1 and nd2, and this is the formula for deriving the call option price using the Black and Scholes model. Now over here the terms d1 and d2 are new terms, so I have defined them separately, but you don't need to memorize it. What we need to understand over here is there is an unknown term over here, which is the sign of volatility, right? The variance sign. Now if you closely look, all other terms are observable. You can observe the time, you know what is the strike rate, you know what is the stock price, you know what is the risk free rate. The only unobservable value is the volatility, right? So when you know all other variables, you can compute the volatility. Since this volatility is computed from the formula and it is implied by the formula, hence it is known as implied volatility. If I go back to my screens over here, you see this implied volatility. Now, implied volatility is computed using the Black-Scholes model. Right? So what is ND1, ND2 in layman's language? So D1 is the probability of the option being exercised in the money. Right? So if you have an option and suppose you have bought the option at 150 and the current market price is of say 130 and your expectation is 180. So as long as your stock price is above 150, you are in the money. So the probability that your option will end up being in this range, I did a mistake, I think so. Yes, 150 is my strike, 180 is the expectation. Okay, yeah, so this should be 120. So I'll just erase this and again start. Yeah. Suppose you have bought an option for strike 120 and the current market price is 150. So as long as your strike price is below the stock price, you are going to be in the money, right? So the probability that your option will end in the money is known as D1, and the probability that the option will not be exercised or will be out of the money is D2. So this is in layman's language. Now over here there's a new term N. N is basically normal distribution. N is normal distribution. We all know that normal distribution looks like this at the bell curve, the mean of 0 and 1 standard deviation. So what is the basic assumption of Bsm model is that the prices are normally distributed, but that is not the case, right? Your prices might not be normally distributed. It might have skewness, it might have kurtosis, right? So what I'm trying to tell you over here that the base assumption of the Bsm model is normal distribution. Hence, Bsm model is just a approximation of the call option price because it assumes normal distribution and seldom the market shows normal distribution. So that is why you have to take the implied volatility as an indicative value and not as a definite value, right? It has to be an indicative. It just gives you an indication of the volatility. Okay, so this is the simple explanation of Bsm model. There's a tons of articles online to understand that. What I've tried to done over here is to explain you in a very simple manner. Okay, now what is Vix and how to interpret and trade and when to buy and sell options. So Vix is basically the volatility of the index. It was, I think so, coined by CBOE and the Chicago Board of Exchange, Derivative Exchange. And what it is basically it is the expected volatility in next 30 days. So why is it important? Why are we discussing Vix? So if you see from January, February, March, say April, May, June, okay, the Vix was like this over here, and when the pandemic started, it went like this, and now it's gone like this, and suddenly it has again started rising. This was the level of Vix in March, 82. So 82 is very high volatility, right? If you see, compare it in the graph itself, current volatility is around 35. In March, the volatility went at 82. So why it went till 82? Because we all know what happened in the month of March. The Sensex and the Nifty saw a very huge fall, and the Nifty went from 10,900 to 7,650 in the month of March itself. And that is why the VIX is showing a value of 82 in the month of March. Now what happens and how do you interpret and trade VIX? So interpretation, I've told you that higher the value, more volatile is the market and more volatile is the expectation of the market. Let me take an example from yesterday's trade. So this is yesterday's expiry market. If you see, the market has opened at 9:15 over here, and look at the volatility. It opens, goes down, rises up, goes down steeply, rises up steeply, goes down steeply. This is the intraday volatility. Just imagine the dilemma of the option trader, and he has no way to know what are the support and the resistance levels at in the intraday trade. So how do you trade when you don't know and you don't understand what are going to be the levels of your trades today? So what you do is basically you choose what to do with your option. You either buy or you sell the options. Now from the definition, we know that Vega Vega has a positive Vega has a positive impact on the market, right? Your call option increases when the Vega increases, and the put option also increases when the Vega increases. So now we know that if the Vega is positive, we should be a call option buyer, right? But imagine what would have happened if you had bought the call option at this level. you would have suffered a lot and your stop loss would have triggered. Again at this level, if you see the volatility is rising, you would have bought again at this level, and again your value would have decreased. And consequently, suppose you are a put buyer and you bought a put at, say, these levels, assuming that the market has shown 7 red candles continuously, you buy a put over here and look what happens. Again at this level you buy a put and look what happens. So what to do? Neither the call is working, neither the put is working. So a very simple and a very old strategy which always works is the long straddle. In the long straddle, you buy the call and the put of the same strike, right? So if I had bought the call and the put at this level at opening of say 10,200, so I would have profited over here. I would have profited over here in my calls, but I would have lost on the put. If I was using multiple indicators, I would have known that this is a 20-day resistance, and I would have sold my call over here and booked my profit. And now I would have left with put, and when the resistance comes into play, the market goes down, my put benefits. So both my call and put end up profitable, and I till here I was hedged, so I was having a net close to zero loss. But now when the stock has reached its resistance level of 20-day in intraday, we know there is going to be some profit booking over here. So we square off our call and we keep our puts intact, and when we see that it's going to hit my intraday resistance level and support level at the downside, we square off our put also. So at the end, what we need to do is basically take both a call and a put when the volatility is high. Why? Because long calls and long puts increase when the volatility is high. Consequently, if the volatility is very low, right? I will not say that you should sell options, because selling options requires a lot of margin, and I don't know whether retail investors are really aware of how much the margin is calculated, how the margin is calculated, why you need to do the mark-to-market settlements every day. I will cover that in another video where we are talking about selling call options. But just remember, whenever the volatility is low, don't trade in options, because what will happen? This will happen. Imagine this is a 22 June Nifty chart, and today was expiry, so just don't consider this one. Just consider this flag. Look where the option has opened. It has opened around, I think so, 534. Yeah, 534. And look where it has closed. 320. On this day, the volatility was very low. And what happened to the market? Why the option went down so much? It is because Vega went down. It is on 22nd June. 22nd June means it is approaching the maturity. What happens when you approach maturity? Your theta becomes exponential, right? It will erode 100, say 200 rupees of theta in one day. Just imagine over here, Nifty is at 10,091, option price at 534. The intrinsic value is 210, and 324 is the premium that the call seller is asking you for the volatility and the time value. So time value, I've clearly explained in the last video that it is your enemy. And imagine, he is selling the volatility. Essentially what he is doing, he is selling the volatility. He knows that the market is not going to go, really, say 200 points or 300 points intraday. He is selling the volatility. And by the end of the day, look at what happens to the option price. This is a one-day candle. It has lost 300 rupees. This is what I was explaining, that don't overpay for your options. Don't do blind trading. Look at theta, look at Vega, and when you look at Vega and you see it is low, better don't buy or sell options, and if you see that the Vega is high, you need to buy options. Selling options I will consider in some other video. We'll wind it over here, but as always, you can put in your comments and questions. Thank you.